Hi friends, in this video we are going to see what is a PE ratio and how to interpret it. The formula for PE ratio is price divided by earnings. This denotes number of times an investor is willing to pay as a price for a company's earnings. Price to earnings ratio is one of the primary metrics used in this respect, as it helps determine whether a stock is overvalued stocks or undervalued stocks. This ratio should be used in comparison between similar types of companies. Different industry will have different levels of price to earning ratio. For example, companies dealing in daily essentials will have a higher ratio in comparison with others. In case a company exhibits a high PE ratio, it signifies that the company's share prices are relatively higher than its earnings. Hence, can be interpreted as overvalued. This approach allows investors to avoid a value trap. On the other hand, if the company exhibits lower than industry PE, it signifies that the stock prices are undermined in relation to the company's earnings. Value investors consider this scenario as a positive indicator for investments, as they can purchase these stocks at a lower price when compared to its intrinsic value. They sell it at a higher amount later when such stock prices rise. But, is it so simple? We have to consider another way around too. The price to earnings ratio shows the confidence of investors in relation to a company's share price. If a company is not performing well, there is a lot of chances that the price to earning ratio to be low. The investors may be trapped on seeing attractive PE ratio of bad companies. The same applies the other way around, where, if a company performs very well, the demand for that company boosts up, increasing its share price, resulting in a high PE ratio. Hence, to arrive at a conclusion, buy companies with low PE ratio compared to its peers, which is performing better than its peers. Value investing requires a long-term holding of stocks for investors to realize their profitability fully. The concept of valuation is subjective. It might differ from person to person. Investments are subject to market risks. Do your own research before investing.